Hello and welcome. My name's Kevin Igoe, Managing Director of PFP, and I'm delighted to be introducing today two experts in the subject of cryptocurrency. One of the subjects that we know HMRC are taking a lot of interest in now, and for many of us, it is somewhat of a mystery, how to deal with it and what exactly they are. So I'm delighted to introduce Alan Kennedy and Ryan Conlon of Trident Tax, a consultancy based in London and throughout the UK, I guess. So firstly, if I could ask each of you to introduce yourself and a little bit about your background. So Alan first, please.
Hi, good afternoon, everyone. I'm Alan Kennedy. My background prior to starting this business 12 years ago was that I spent about 8 years at KPMG. And prior to that, I was a specialist investigator at HMRC for Special Compliance Office. So our business does a lot of tax investigations and tax resolutions work, as well as quite a lot of tax advisory work for high net worths with overseas structures. But none of us are accountants, so we're a pure taxation practice.
Great, thank you very much. And Ryan?
Good afternoon, everyone. I'm Ryan Conlon. I'm a chartered tax advisor here at Trident Tax. My background is, like a lot of us here at Trident Tax, passed through both KPMG and HMRC at various times. I'm a private client specialist, and I've been advising on crypto assets for probably 4 years now, and probably reflecting changes in the market, originally starting off helping people with disclosures, but more recently helping people to actually structure their crypto holdings.
Okay, great, thanks very much. So we will, as usual, be sending around slides and possibly a recording after the webinar, so you look forward to that. Alan and Ryan have said they're quite happy to take questions throughout. As ever, they've said the thicker and the thornier, the better. They like those sort of questions. Now, I understand there may be internet problems around the UK, so it's not our system or yours, it's somewhere general. If anybody does have any sound issues, can I suggest you use the dial-in on your telephones as well for sound, because that'll circumnavigate that for you. So, thank you very much. Without further ado, if I hand over to Alan and Ryan.
Okay, thank you very much, Kevin. Okay, what we're going to cover today, what we're going to focus on, is the personal tax implications of acquiring, holding, and making disposals of crypto assets. There are also, potential business tax implications as well, but we'll leave those aside for today. So I'm going to run through, what are HMRC's current attitudes on crypto assets, how does it view them, and then we're going to look at some more specific issues in more detail, in particular how they're treated for capital gains tax, income tax, inheritance tax, and we're going to round off talking about recent HMRC compliance activity. Really is a hot topic at the moment. Over the last month, HMRC has been issuing nudge letters to holders of crypto assets in the UK. So we'll finish on that. So I'm going to start off providing a very brief introduction to crypto assets. For anyone outside this, the terminology can be quite intimidating. You really can go down the rabbit hole with finding more and more new terms. I don't intend to go into detail to all these things, but I want to give a brief overview. So we see references to crypto assets, cryptocurrencies, crypto tokens. There may be subtle differences between them, but for the purposes of this webinar, and certainly for HMRC purposes, we use them interchangeably. So my preferred use, same as HMRC, is crypto assets. A crypto asset is, if you like, it's a cryptographically secured digital representation of value that can be transferred, it can be sold, it can be traded electronically. All crypto assets rely on something called distributed ledger technology, or DLT. A DLT is essentially a centralized system that records transactions simultaneously in multiple different places. So it's not quite like a traditional centralized database that might be held on a single server. The ledger in the distributed ledger technology is a an immutable record of all transactions that have ever happened on the network. And one application of that is, another familiar term, is blockchain. Blockchain is just a particular application of DLT. Because the technology is distributed and there is no central person or organization controlling it, all transactions need to be verified some way. This is called a consensus mechanism. And there are two principal types, proof of work and proof of stake. The best known is proof of work. So lots of press attention to the environmental impact of crypto assets because of the mining activity that goes on. Essentially, this is solving complex cryptographic puzzles in order to win the right, if you like, to make new entries to the blockchain. So that's called proof of work. And the other way is called proof of stake, where the right to make entries to the ledger goes to people who have existing stakes in the relevant crypto asset. Public and private keys, these are terms from cryptography. Cryptography underpins the operation of crypto assets. A private key is a randomly generated string of characters, and that's used to authorize a transaction involving crypto assets. A public key is is mathematically generated from the private key. Exchanges and wallets. Exchange is simply somewhere where you can buy crypto assets, sell crypto assets, where you can exchange your pound sterling to buy Bitcoin or another crypto asset, where you can then sell your Bitcoin for other crypto, and then where you can change it back again. A wallet is the term that's used for where you actually hold your private keys. The wallet could be anything from a piece of paper to online systems. Fiat currency, when we refer to fiat currency, we refer to non-cryptocurrencies and non-crypto assets, so sterling, dollars, and so on, or fiat currencies. So what are HMRC's views on crypto assets? Well, these have evolved over time from the publication of a Revenue and Customs brief in 2014 through to, things picked up pace in late 2018 with a publication of a policy paper on crypto assets, which was then updated the following year, and also around about the same time the following year, a policy paper on crypto assets for business. All that information is now consolidated in a HMRC crypto assets manual, and like all HMRC's manuals, it is intended primarily for HMRC staff, but actually it's available to the public as well on HMRC's website, so that you can see what HMRC's attitude is to crypto assets and how they treat various types of transaction. So what is HMRC's view on crypto assets in general? The important thing to say here is there is no legislation, no tax legislation, indeed no legislation at all, on the treatment of crypto assets in the UK, and there are no decided tax cases. There are some other cases which might have some bearing on the tax treatment, but there are no tax cases. So at the moment, we're left only with HMRC guidance, so there is the crypto assets manual. This guidance, I should say, is in itself quite limited. The area is rapidly developing, so it's not comprehensive. And in particular, it focuses on what HMRC calls exchange tokens. Exchange tokens are crypto assets which are held out to be a means of exchange. So they're like a currency. So either they're a means of exchange or a store of value or a unit of account. The best known is Bitcoin itself, but there are others. There are other types of crypto asset as well. So not just exchange tokens. So there can be security tokens, utility tokens, and stable coins. Security tokens are crypto assets which are underpinned by something else. So there might be, I don't know, some sort of physical asset, a security, a share, something like that. Utility tokens give the holder the right to access some service or do something. And stable coins are a later development. An example of again from press attention to this. You may be aware that often crypto asset prices are quite volatile, may go up and down, significantly. In fact, actually over the last week, you may have seen there was a major drop in the value of Bitcoin. Stable coins are crypto assets which are backed by some asset which therefore it tends to actually lend some sort of stability to the price. An example would be Tether, which is supposedly backed by the US dollar. The key thing moving toward the tax treatment is that HMRC considers crypto assets to be, well, they are assets. They are chargeable assets and therefore potentially subject to capital gains tax on disposal. And we will spend some time in the next slides talking about the capital gains tax implications. Crucially, however, crypto assets are not currencies. So no matter, some people who may see them as a virtual currency or the future of money, but for HMRC's perspective, they are not currencies. And HMRC here follows the Crypto Assets Task Force, which was a group set up involving the Treasury, the Bank of England, and so on. So in HMRC's view, they are not currencies. They are assets, but they are not currencies. Specifically on the taxation of crypto assets, HMRC's view is that most people will be holding them as investments. So any gains realized when they're sold will be subject to capital gains tax. They say it would be unusual for an individual to be carrying on a trade in crypto assets and therefore subject to income tax. But there are some activities where there may be an income tax liability, so-called mining activities, staking, airdrops, and so on. We'll come back to those later. One important point to highlight is that HMRC's view, and here HMRC's view has arguably changed from its original statement in 2014. HMRC does not accept that holding crypto assets is gambling. There seems to be still a widespread misconception about this. Certainly I've come across individuals who thought that they didn't have a filing requirement on the basis that the profits that they'd realized were essentially profits from gambling.
We've got an early question there from Tom. What would constitute a trade as opposed to a capital gains tax transaction? How many transactions constitute a trade, for example?
That we will come back to that in some more detail later. So, it's a question of fact whether there is a trade. The difficulty here specifically, and I think why we get this question quite often, is that frequently cases I come across where people have been buying and selling crypto assets, because of the nature of the asset and the nature of the way the exchanges work, they can generate very high volumes of activity or high volumes of transactions, which can make it look like, I've had instances of people having in a single year many tens of thousands of transactions, but part of that is an artifact of actually how the exchanges work. So if it's okay, we will come back to the income tax treatment a little bit later.
Okay, great, thanks.
Yeah. For now, though, I want to focus on HMRC considers that most people will be subject to capital gains tax. Well, when does the capital gains tax come into play? Well, it's on a disposal. And disposals here will include selling your crypto asset for cash. So you sell your Bitcoin or your Ethereum or your Ripple or Sterling, you have a disposal of your crypto asset. So you have a potential gain or potential loss. But you will also make a disposal if you use your Bitcoin, for example, to purchase goods and services. So, there are some businesses, in fact, I think there are some accountancy firms even, who will accept payments in Bitcoin. When you do that, you'll be treated as making a disposal of that crypto asset. And again, you will need to calculate a gain or a loss. If you make a gift of crypto assets, again, it's a disposal. The point, however, I'd really like to highlight, and it's absolutely crucial, and this is where there is widespread misunderstanding, among people who hold crypto assets is that if you exchange one crypto asset for another, you will be making a disposal for capital gains tax purposes. What I often see is the misunderstanding that I take my fiat currency, let's say some sterling, and I buy some Bitcoin with it. I then take my Bitcoin and I buy some Ethereum or other crypto assets, and I use that crypto asset to exchange with further crypto assets, and eventually I change back again to sterling. We come across people quite frequently who think that, well, whether or not I've made a gain or a loss depends on how much sterling did I put into the exchange, how much did I get out at the end. That is incorrect. What you need to do is to recognize that each exchange between the crypto assets is itself a disposal. So obviously, given what we mentioned a few minutes ago, given that people can generate quite easily very large volumes of transactions, this makes things complicated. But it's crucial to understand that each exchange is a disposal for capital gains tax purposes.
Okay, so we have a question from Monica. If I sell Bitcoin today and buy another Bitcoin the same day again, is it a disposal?
Well, yes, it is. However, and I've moved on to another slide, which is that, yes, that will be a disposal, but I'm sure many participants on the webinar will be familiar with the pooling rules, which apply to when you make a disposal of shares, for example, from a holding of shares, in terms of how do you allocate the base cost. So when you make a disposal, let's say you have a holding of Bitcoin, to make things simple, that you've built up over time, and you then make a disposal of some of those Bitcoin. What is the base cost of the Bitcoin that has been sold? Well, the pooling rules, which also apply to crypto assets, not just to shares, say that you need to match the disposals that you have made to acquisitions that were made firstly on the same day, then to acquisitions which were made in the following 30 days. So in other words, potentially to acquisitions that are made after the disposal, and then to a pool of the average cost of the remaining Bitcoin in this case. So to take Monica's example, if she sells and buys, well, you would have to match the original sale to the purchase on the same day, or if it's the next day, when calculating whether there's a gain or a loss.
Okay, thanks. Question from David. The CGT pages say disposal should be declared when proceeds exceed 49,200. Does this apply to crypto assets, even if gains are below 12,300?
Yes, it does. So it applies to all assets. So it will apply to crypto assets as well.
Okay, great. Okay, thank you.
Okay, so the next point I wanted to talk about, again, I said that the more you get involved in this, the more terms come out. So one of the terms to be aware of is a hard fork. A hard fork is essentially where, because these crypto assets generally work by consensus, when the people behind them, let's say, have a falling out or decide to go their separate ways, it can result in the creation of a new crypto asset. Probably a big example of this involved Bitcoin itself in, I think, 2018, maybe 2017, Bitcoin split into Bitcoin and Bitcoin Cash. And this is what's called a hard fork. In this case, HMRC says that you need to allocate your base cost between the original holding that you had and the new crypto asset that you hold. So it's kind of like a demerger. Also to be aware of, again, when you're calculating your capital gains tax gains or losses, you can deduct various incidental costs of acquisition and disposal. However, the legislation obviously doesn't deal specifically with crypto assets, but it's quite prescriptive in terms of what you can actually claim as a cost of acquisition and disposal. One thing to note here is an HMRC themselves in the crypto assets manual discuss is whether or not certain exchange fees are deductible when calculating gains and losses, and some fees in particular, HMRC argue, would not be allowable. So for example, some exchanges will charge a fee when you introduce sterling into the exchange. So HMRC's view in that case would be, well, sterling's not a chargeable asset anyway, so there's nothing to deduct. In other cases where it might be another currency other than sterling, what they might argue is that you're holding previously, basically there's been no change in what you held, so or what you hold. So you had previously had foreign currency on the exchange, you've got foreign currency off the exchange, so you haven't really made a disposal, so any exchange fee wouldn't be allowable. So that just needs to be, you need to be aware of that. The pooling rules, which I outlined at the beginning there, do not apply to so-called non-fungible tokens. So non-fungible tokens are, for example, crypto artworks and collectibles. In this case, because they're non-fungible, in other words, unlike a Bitcoin, so one Bitcoin is interchangeable with any other Bitcoin. In these cases, because they're collectibles or artworks or so on, they're not interchangeable. They're unique by definition. So therefore, the pooling rules would not apply to them. So instead, you would just calculate gains and losses in the normal way for those. Again, so we've talked mainly about gains, but obviously disposals can give rise to capital losses where the disposal is for less than the cost of acquisition. Here, capital losses can be claimed within 4 years of the end of the tax year in question. There is a potential opportunity here, I think. Certainly, I said I've been involved in advising on crypto assets for at least 4 years, and the last boom in crypto prices was in December 2017. And because there was so much attention to it, lots of people got involved in crypto assets around then, but they got involved too late. So they bought at the top of the market and ended up realizing losses. Well, that was in the 2017-18 tax year. So for people like that, if they haven't done it already, they still have until the 5th of April 2022 to make a loss claim. Negligible value claims are also possible for crypto assets. So a negligible value claim permits you to make a deemed disposal of an asset which has become of little or no value. So it's not a true disposal, but a deemed disposal. So someone who might have acquired some sort of crypto asset, let's say a few years ago, has put some money into it, the project failed, the asset is now worthless, there is no market for it because no one wants to buy it, they can apply to HMRC or make a claim to HMRC that they can be treated as having disposed of that asset and then reacquired it at its current market value, so zero. So let's say someone put £10,000 into an asset some years ago, it's now worthless, they make a claim to be treated as selling that asset for nothing, so therefore they have made a £10,000 loss, and that loss can then be set against gains. HMRC provides some further guidance on what doesn't count as a disposal for capital gains tax purposes. So, I've outlined what is a disposal, but HMRC also discusses what is not. So, for example, if you lose your private key and you no longer can access your crypto assets, well, you have not made a disposal. It's just that you can't get into it. If I lose the keys to my flat, my flat's still there, I can't get in, but it's still there and I still own it. So you lose your private keys to your crypto assets, well, you still own it. HMRC, however, have said that they might entertain a claim for a negligible value claim if you could demonstrate that there was no reasonable prospect of you recovering that private key. HMRC also discusses instances of fraud and theft. Again, if your crypto assets are stolen, then you haven't made a disposal of them. Someone's taken them, but you haven't made a disposal of them. So again, you can't claim a loss in that situation. What you can do potentially, however, would be if the asset that was stolen subsequently became worthless, you might be able to make a negligible value claim in that case. But theft in itself is not a disposal. Some of the practical issues that come up when dealing with crypto assets and disposal of crypto assets. The first one is record keeping requirements. You are obliged to keep sufficient records to allow you to actually prepare your capital gains tax calculations. So you need to keep records of what you've bought, for how much, and what disposals you have made. One common issue we have, it has improved over time, but commonly for people who've been involved in crypto for some time is missing information from earlier years. And those individuals may need to consider how they go about calculating their gains and losses, particularly if they don't have information on the base cost of what they acquired. Strictly it might be that they have to actually, if they've made a disposal and they don't know what the acquisition cost is, they might have to take that as zero unless they can find some reasonable way of estimating what the acquisition cost was, and they need to actually highlight on their tax return the basis on which they'd estimated the acquisition cost. The volume of transactions can be a big challenge. Particularly, I've already mentioned that we frequently come across individuals who have undertaken, certainly when they provide you with their records, tens of thousands of transactions in a single year. Exchange rates. So again, there are practical issues in terms of, because everything must be rendered into sterling. So you calculate your gains and your losses with reference to sterling, rather than with reference to whatever crypto asset. So let's say you bought some Bitcoin some time ago and then you made a disposal. You'd need to know the value of the Bitcoin that you bought in sterling at the date that you bought it. And you need to know the value in sterling when you sold it to calculate the gain or the loss. Practically, how do you go about doing this? Fortunately, there is software available or various websites which can assist, and many of them are able to actually undertake the pooling calculations that are required for UK tax purposes. Certainly over time, I've seen the quality of the calculations that the software produces is improving, particularly as I know at least one of the main providers is a UK-based company. So the software was originally written with UK tax rules in mind. In terms of the way we've approached this, or how I've approached this in time, is because of the volume of transactions, there was no realistic way that we could actually undertake the calculations ourselves. In terms of the time and the costs, would just be too great. So we've actually had clients use this sort of software, and then we have essentially we have audited the calculations to give some sort of reassurance that they are accurate. I'm going to hand over.
So, Ryan, before we go on though, if we just couple before you hand over then, I've been asked by Oliver, can you recommend any pooling software?
Yeah, obviously I'm not being paid then for any of these people, can I stress that? So what I'd say is I'd suggest that the one that I used most recently is one called Recap. So Recap, so R-E-C-A-P, so it's recap.io. That's one example, and I know the guys who are behind it they're originally based in the UK, but there's others as well. There's Coin Tracking, and then the similarly named Coin Tracker.
Okay. Will these okay, somebody's asked, will that software also calculate the capital gains, or does it just set out the transactions?
No, it automatically calculates the gain. Certainly in Recap's case, I know that it does the pooling calculations.
Okay, and does the software take into account disposals on staking transactions?
That's a good question. It depends on what information is entered into them. One of the things I would say is that where the software can be very useful is actually identifying any anomalies. So, and then you can go in and often actually edit transactions yourself to actually take into account various circumstances.
And will it recognise same day matching?
Yes, it will. Yeah, it'll apply the rules. Yeah.
Okay. Yeah, carry on.
Yes, I was going to say, because different countries have the solve the issue in different ways. So the US, Australia, they use different matching rules. So originally, some of the software I saw was written for a US audience. Obviously, was applying the matching rules, in a US way. But I think even some of those now recognise the UK rules.
Okay. Someone's come back straight away, as I would expect. What are staking transactions?
Staking transactions are going to be covered in a separate slide in about 5 or 10 minutes time.
Excellent.
Everyone's very eager and running ahead.
Yeah, which is good. It's good. You mentioned about the record keeping. Now, Keith has a client who has done many transactions in crypto assets, yet he claimed that the records of those transactions weren't in his ownership, so he couldn't provide full details. Now, if there is some sort of agency or management arrangement whereby someone else has the details, why can we not produce those records, and how do they get to the bottom of every transaction to see if there have been exchanges or sales?
Certainly for people who have used some of the the more popular exchanges, they should be able to generate the record should be on there. So generally what you can do is download a list of the transactions in CSV file format. So it certainly should be possible if they have been using some of the larger exchanges.
Okay, thank you. David's asked, so go on.
Yeah, the difficulty can probably be more in a disclosure case. Certainly, I've had instances in the past where people might have got involved in crypto much earlier, and the quality of the information either they kept themselves or what the exchange did, was not as good as it is at the moment. And there have been instances in the past as well where exchanges have vanished.
I think the reality is it's going to be an imperfect situation in some cases, and HMRC recognise that, and that it has been the Wild West in a way, and a pragmatic view is going to have to be taken one way or another on client-specific cases, and as long as you're transparent with HMRC and it's evident that you're not trying to pull the wool over their eyes, I think they will be accepting of that, the limitations of information.
Okay, a more general question here from another David. Will tax implications of cryptocurrencies change if the business structure is different, i.e. whether it's a limited company as opposed to an individual?
Do you mean
will it be treated still as trading income as opposed to, Yeah,
I mean, potentially it could, but it's really about the level of organisation. And as a former HMRC inspector, I know they'll be looking at what they call the badges of trade. There are 9 badges of trade, and they will see how, whether it's a company or an individual, how professionally they've set themselves up. So we have some clients now, for example, who are using algorithms to trade on the volatility of crypto, and the level of organisation that they have means, and we actually saw a barrister about this last week, that there is a very good chance that even for an individual, he will be regarded as trading.
Okay, thank you. Another question: if GBP is paid, Great British Pounds is paid from bank to exchange. Are the exchange fees claimable?
From bank to exchange, no.
Yeah.
And that's, you can find it in the cryptoassets manual. If you search for it, there is a table where HMRC sets out all the various different circumstances, but certainly in that case, that wouldn't be, because essentially what you're doing is you're just swapping sterling for sterling. So you're taking sterling out of the exchange, sterling into the exchange. So there's going to be no allowance there.
So a general comment stroke question on here from Paul, who feels that the younger generation really hit the crypto bug, if you like, during lockdown, of no knowledge of the tax system. Do the trading sites have any tax health warnings to users?
That's a good question, whether or not they actually have a health warning. This is, Alan used, the term Wild West at the moment, and it still does have that feeling. It is becoming more regulated, but whether there are.
I mean, there are websites that advise people on, how to get started and how to go about things, and they do have the standard sort of warnings. You may be liable to taxation. Depends where you live. I think I was talking to someone a few weeks ago, and they were saying, if I remember rightly, Portugal doesn't tax crypto at all. So it does vary, and these are international websites. So it will, I think, inevitably just be a very bland comment about, you need to take taxation advice, because the tax treatment will vary from country to country, but it's not going to be written in huge letters on these websites, I'm afraid.
Okay, thank you. Daniel asks, he understands that exchanges such as Coinbase now pay interest on cryptocurrency holdings. Is this liable to income tax?
That's something effectively that we're getting onto when we talk about state. In essence, that's really what that is. Okay.
Ravi asks a basic question, she says, but if you buy Ethereum with Bitcoin, the value of the Ethereum increases and you exchange for sterling, are you taxed on two disposals?
Well, so you buy Ethereum with your Bitcoin, so that's it.
Yes.
So you've made a disposal of your Bitcoin, so you have to calculate a gain or a loss. And then when you buy the Ethereum with your Bitcoin, you're then making a disposal of your Bitcoin, and you have to calculate a gain or a loss.
Yeah, and again, because these currencies, the values are expressed usually in US dollars, people who are investing tend to look at whether it's gone up in US dollars and decide whether they've got a gain or a loss. But you have to take the foreign exchange aspect into account.
Yeah.
And, what might be a dollar loss could be a sterling gain. So a lot of care is required over that, because they can get a nasty surprise at the end of the year if they haven't kept track of what they've been doing.
Yeah, Toby makes the point, thank you, Toby, that about how the agencies that exist, exchanges, they obviously are keeping some records because HMRC are getting information from them to send the nudge letters.
Yes, they are. Yeah. So we're going to. That's in probably my very last slide. I'm going to come back to that and talk about what does HMRC know. Okay,
great. So we've had quite a few questions so far. Please keep them coming in. I'm not going to interrupt with more questions for at least 10 minutes or so now, but do keep them coming in, because I'm aware we've got 20 minutes left. So back over to you, gentlemen.
Okay, so we're going to move on now, and we're going to talk about Situs of crypto assets. So where is crypto actually located? Because it's out there in the ether, as it were. So does it even have a location? And of course, for tax purposes, it does need to have a location, because that will determine its tax treatment. That's particularly important, or in theory, it's particularly important if you're a non-UK domiciled person who's tax resident in the UK. It's also important in theory if you're not non-dom, you're a typical UK domiciled person, because if you fail to report your tax liabilities in relation to what are called offshore matters, then there are longer time limits for HMRC to make discovery assessments, and there are higher tax geared penalties. However, based on HMRC's current views, all of that becomes rather academic. And that's because HMRC believe that crypto is cited where the owner of the crypto is actually located. So what does that actually mean? Well, for non-DOMs, it's a bit of a disappointment, to be honest, because it means that they cannot elect for the remittance basis for taxation on their crypto gains. So typically the non-DOM who has assets offshore can elect for the remittance basis, and that means they will not be taxed on the overseas income or gains unless it's remitted to the UK. Of course, HMRC saying that they believe the crypto is already in the UK because the owner is in the UK means the remittance basis is simply not available. Now, it took HMRC several years to come out with that view, which is very unfortunate, because it means in many cases non-DOMs may have historic tax liability that they need to declare. But there's a problem that arises because of this even before they make any money from crypto, and that's if they use their overseas income or gains that have been earned since they've been UK resident and which are being subject to the remittance basis, so they haven't been taxed yet. HMRC's view means that when they use that overseas money to buy crypto, there's an immediate taxable remittance of those funds. So you start off with a tax liability before you've made a gain or a loss on the crypto itself, which is not great news, and it is going to be a problem for non-DOMs. However, there are some structuring opportunities. If we think about the use of protected trusts to hold the crypto, then it should be possible to gain exposure to crypto as a non-DOM and still benefit from the remittance basis of taxation. As Ryan said earlier, there isn't any tax legislation in the UK, at least, on crypto. So HMRC's view does not have any statutory basis at the moment. It's quite a simplistic view, and it's based on the fact that they're comparing it to the citus of a debt. So there's a line of case law which was probably started with something called the Greek bank case, and then it developed into the latest sort of version, which is Perrin and Ardmore construction, about the citus of debts and the source of income. And really the main point to emphasize is that those cases said that the citus of the debt should be primarily determined by where the debtor is and where you would go to enforce collection of the debt. Now, in my view and many other people's view, crypto is nothing like a debt. You know, HMRC have likened it to a share, so it's not really clear why, you know, they are comparing debts and saying that should determine the citus of crypto assets. If we were talking about shares, the citus of foreign shares is not where the owner is, it's where the shares are registered, and it's where the shares can be traded if they're publicly listed shares. So it doesn't seem to bear an awful lot of scrutiny. STEP have published their view on the matter, which is a much more nuanced view, and I think it's based on the work of a leading academic in the crypto sphere. And boiling it all down, I think in essence what they're saying is that if you have an individual who's in the UK, and let's say they're a non-DOM individual, if they're sitting there with the public key, the private key, and are able to transact with the crypto, then there probably is a good argument that that crypto is located in the UK. But if the private key is not here, let's say it's being held by their investment manager in Switzerland, then the view would be that it's non-UK citus. But it does create a bit of a dilemma as to the filing position that you can take. STEP's advice is that if you're not going to follow HMRC's view, you should make a white space disclosure on the tax return. That's really going to put you fairly and squarely in HMRC's site for an inquiry, but it may be worth taking that position, because ultimately I expect there's going to be some litigation on this, and someone who has enough money to make it matter to them will probably go through the tribunals and the courts with HMRC. And even if your client doesn't have enough money to make it worthwhile to litigate, it may be possible to prolong things and essentially wait in the wings to see what the outcome of that litigation is. But certainly, I wouldn't expect there to be penalties in the event that the argument was lost, because HMRC's view, as I say, is a very simplistic one. And if you're taking, for example, the step view, then I think you're taking a very considered and technically thought through position. So we'll no doubt see that develop, and I expect it will be over several years. Okay, so moving on from Situs to income tax, which I know has cropped up a few times in the discussion already. So when might we have an income tax liability? Well, there's mining and there's staking. Now, mining, Ryan has talked about already, which is obviously done on an industrial scale. And if you are sufficiently well organised, you're committing lots of resources to it, then HMRC are probably going to say that you meet the conditions for this to be an adventure in the nature of trade. And what you realise from your mining activity would be chargeable to income tax. Even if it's not a trade, they would say it's chargeable to income tax as miscellaneous income. Staking is potentially a bit different. Someone talked about interest, and I think that's a really good analogy. So I was talking to someone a few weeks ago, young kid about 22, 23, and really that's what they were doing. They were making their money from staking, which effectively is the crypto equivalent of making a deposit with a bank and earning interest. I think HMRC's initial view was that that might still be liable to capital gains tax, but now they clearly say it is income tax, because what you receive, or what this individual was receiving, was a return equivalent to about 25% a year on her particular crypto that she had deposited. So she received more tokens of the same kind. They will be valued at the time they're received. So another timing issue here, another foreign exchange issue. What is it worth at the time that you receive it? Because that will be the value that you're taxed on in your next tax return and chargeable to income tax. You're left with all these crypto tokens. At the end of the year, you know, if they fall in value by 90%, too bad. You're still going to be taxed on the value that you achieved at the time that you received them. Airdrops, a little bit different. I always think of them a little bit like a bonus issue of shares. Sometimes they'll go to the people who already hold a particular token, and they might be doing something to promote that token or promote some service or other, and they'll receive bonus tokens in some form. So they're doing something for that. It might well not be trading, but it would just on general principles be treated as income. And as we've said there, when you get rid of it later, then you'll be chargeable to capital gains tax, because that's the asset you've received as a capital asset. You're not trading in that asset particularly, so it's not stock in trade. Another development which I think is a sort of a variation on staking is what's called yield farming. I confess I don't know a lot about that, but again, it looks like HMRC's view will be that that's chargeable to income tax. On some occasions, we encounter people who are going to receive crypto assets in connection with some form of employment. It also could arise in the form of consultancy income, but they are doing something. They're going to be a director, perhaps, of some kind of fund or some kind of asset or venture, I should say, rather, in the crypto sphere. And instead of being paid in normal cash or fiat currency, they're going to receive crypto assets. So in those circumstances, it's a bit like the staking, except that here the charge is to employment income tax, and consequently we would also have a potential liability to national insurance contributions as well. The crypto you receive is regarded as a readily convertible asset. It's as good as cash in theory. You'd be taxed on it on receipt. Again, if the value goes down, too bad. If the value goes up, then you're going to pay capital gains tax on it. And then, of course, inheritance tax, which is not really something that most of the younger investors are going to think about, but these assets are chargeable assets for inheritance tax purposes. And again, for the non-DOMs, on the basis that the non-DOM is UK resident when they pass away, they'll be regarded as UK Situs assets and they will attract an IHT liability. If the non-DOM has ceased to be UK tax resident, at the time of their death, they still own the crypto, then they should be outside the sphere of IHT, unless the non-DOM, of course, has become deemed domiciled in the UK, in which case their worldwide assets would be called. Everyone's got the nil rate band, which is fine, but obviously lots of people we meet in this area have millions and millions, so that the nil rate band is often not much good to them. So that's IHT briefly, and I'll hand back to Ryan at this point.
Thank you, Alan. Certainly, we're seeing increased HMRC activity in this area. So there's a reason why HMRC have a crypto assets manual for its staff. You know, if they weren't going to undertake compliance activity in this area, they wouldn't need to have an internal manual. In terms of what is driving HMRC's inquiries into this area, well, there's a few different sources of information that they are able to rely on. And the big one which has grabbed some attention has been so-called data holder notices issued to certain UK exchanges, one of which is certainly to Coinbase, and Coinbase has actually spoken publicly about it, but I believe various other exchanges, including eToro, received similar notices in 2019. And certainly in Coinbase's case, I think the data holder notice was very wide ranging, saying to basically hand over all your information. There was some subsequent discussions with HMRC, and in Coinbase's case, they managed to restrict that to basically people who were using the exchange who had a UK residential address and who received deposits of £5,000 or more of crypto assets into their account with Coinbase in the 2019-20 tax year. So certainly we know that HMRC has received information from at least UK-based exchanges. They possibly are receiving information from overseas, although at least currently crypto assets are not covered by the Common Reporting Standard, so that wouldn't be the mechanism, but they may be receiving information other ways. They will also be receiving information via self-assessment tax returns for people who are disclosing gains on crypto assets. I believe HMRC has a policy to basically automatically open an inquiry in cases where there are significant gains. I think the threshold might be £5 million or more, and which is a lot of money, but I've certainly seen plenty of people in the crypto sphere who have realized gains of that and a lot more. Those individuals can expect to receive an HMRC inquiry. They'll also be receiving information from the Digital Disclosure Service, where people have made disclosures of crypto liabilities. And I know this from my own experience when I've done this on behalf of clients, that certainly we got a lot of scrutiny from HMRC into the disclosures that were made, even though actually ultimately they were satisfied with them, but they were certainly looking closely at the information that was being provided. What kind of areas of concern are we seeing from HMRC? Well, when these inquiries are opened, they are particularly interested in whether or not the pooling rules that we talked about earlier are being applied. So are the gains and losses calculated using the pooling rules? And in some cases, they've asked to see primary records so that they could try and do the calculations themselves. They've also asked about whether or not the individual has received any coins through hard forks, airdrops, have they participated in mining activity? And then also seen queries which are less about technical issues to do with crypto assets and more investigation driven. So as you'd expect, those people who have realized significant gains from crypto assets, HMRC has then been interested in what have you actually done with the money? So has that been reinvested into crypto assets, or has that been reinvested into other assets? And has that generated other income and gains that should have been reported? So this is sort of key areas that we see HMRC being interested in. The latest development or escalation in this is HMRC has launched a nudge campaign on crypto assets. I think this was long predicted. Certainly now I predicted it, and it happened over the course of basically last month. HMRC wrote to holders of crypto assets, and I think this information is based on the certainly on the information that they got from Coinbase and so on. That's how they will have identified people to write to. Interestingly, and this has come out from correspondence between the Institute of Chartered Accountants and HMRC, is that apparently HMRC had not written to non-DOMs. So this latest nudge campaign is targeted at holders of crypto assets, but not non-DOMs. Now, that might, in some ways, you might think, does that mean that they no longer are holding to the position that crypto assets are UK Citus? Well, in the correspondence with ICAEW, HMRC have said that no, this doesn't signal any change in their stance on the Situs of crypto assets. These nudge letters, although we've talked about the various tax implications that there can be from crypto assets, are focused specifically on capital gains tax liabilities, and they take what HMRC calls an educational approach. So we've seen other nudge campaigns which have included essentially a certificate of tax disclosure, which have invited the recipient to sign a form and sending it back saying that they either want to make a disclosure or that their affairs are in order. Not the case here. So it's more educational in the sense of informing them that we know or we believe that you hold or have held crypto assets, and there are potential capital gains tax liabilities as a result of that. The nudge letter then invites them to consider whether they need to actually make any disclosures, whether or not that is by, if they're still in time, they might be able to amend a self-assessment tax return if they're already within self-assessment and have filed previous returns, or they could consider making a disclosure using the digital disclosure service, or potentially, if it is a more serious matter where there is a risk of where HMRC might argue that the failure to make the disclosure was because of deliberate behaviour or fraud, the individual might need to think very carefully about what route they might want to take to making the disclosure, and whether or not it might be appropriate to ask for that disclosure to be through the contractual disclosure facility, which would offer some immunity from prosecution in return for compliance with cooperation with HMRC, and in return for paying the tax penalties and interest. On the penalty position, we wait to see what the penalty implication of the nudge campaign will be. Certainly my experience in the past has been that where we have made disclosures, basically making the argument that the area was very new, HMRC guidance was lacking, and the tax treatment was uncertain, that when we made disclosures, we successfully argued for there to be no penalty applied. In this instance, given that a nudge campaign has been launched and people have been nudged, there are implications then for penalties here in terms of if you do subsequently then make a disclosure to HMRC, is this going to be a prompted disclosure rather than an unprompted disclosure? And as a prompted disclosure, the penalties that might be imposed could be or would be higher. That's it from me. That's my final slide.
Okay, well, we have a few questions to get through, just a few. Let's go with the staking transactions. I've had a few on that. Where somebody is involved in staking transactions, presumably their base cost of assets obtained as interest in the value on which they are charged to income tax?
Yes, it would be. Yes.
Yeah.
So the base cost is whatever they charge for the income tax on.
Okay, so Toby asks, on staking transactions, is there effectively 3 disposals? 1, when the exchange for the coin for the DeFi token. 2, exchange DeFi token for original coin when staking is ended. And 3, when the coin is acquired under 2 is finally sold.
Yes. So that's one. That is something perhaps actually should have spoken a little bit more about earlier. As again, so DeFi. So obviously we have someone who actually has been involved in this, but decentralized finance. That obviously this is a growing area, and there's not an awful lot of comment on that. Certainly not from HMRC. But I think the analysis would be that certainly for some. So for example, you can't stake Bitcoin. So often staking has good. Bitcoin operates by proof of work, proof of stake, typically on the Ethereum network. If you are going to stake, say, Bitcoin, you would do that by, it would have to be wrapped Bitcoin. So you would dispose of your Bitcoin for your wrapped Bitcoin on the Ethereum network. So you'd be making a disposal of your Bitcoin, calculate a gain or a loss. You then acquire your wrapped Bitcoin, and then when you came out of the staking, you'd be making a disposal of your wrapped Bitcoin. Then you'd also be, in terms of what your returns were in terms of staking, you're going to be subject to income tax on that, likely as miscellaneous income. That's going to be your base cost, and then the disposal of those coins or those tokens that are received in return for staking, then potential capital gains in future if those are disposed of.
Okay, thank you. A couple on residence. If someone changes their tax residence, what impact does any double taxation treaty have? Or do you need to be ultra careful about timing of the residence change to get the tax treatment aligned to each country?
Well, I think the main point about residence, or one of the main issues, would be, of course, thinking about the temporary non-residence rules. So if we're thinking about someone who wants to go offshore and realise a large gain, so that they're pregnant with gains, they've acquired the assets, which HMRC, of course, regard as UK Citus at the moment anyway. They go offshore, they make a gain of 10 million. Because the asset was held before they left the UK, they'll be, and as long as they were resident for 4 out of 7 of the prior years, they will be subject to the temporary non-residence rules, which means ordinarily, if they're not benefiting from split year treatment in the year that they leave, they'd have to be away for 6 complete tax years. And if they reacquire UK tax residence within that period, the gain would be taxable in their year of return. So I think it's probably not so much about tax treaties, but about residence, really.
Okay.
What if you've got? I was going to say another point. Another point residents to consider would be, there is an opportunity certainly for people who might be coming to the UK, whether or not they make disposals of their holdings before they come, perhaps immediately before becoming UK resident, because I think the next 30 days rule for pooling wouldn't apply to a non-resident. So there would be an opportunity for someone to rebase their crypto before coming to the UK, but obviously that would potentially be subject to whatever the rules are in their previous country of residence, so they could give rise to tax implications there. But there is an opportunity for them to rebase for UK purposes.
Okay, what if your private key is held by the exchange, which is non-UK based?
Well, again, I think that's the step analysis, isn't it, that Alan has referred to. So obviously that's not HMRC's position. HMRC's position is that the situs of the asset is where the residence of the beneficial owner, whereas the alternative analysis provided by STEP is, well, what happens if your private key is held by a trustee, a custodian, an exchange is located elsewhere? Then arguably in that case, under the STEP analysis, then no, it's not a UK Citus asset. But again, that is the STEP analysis, it's not HMRC's analysis.
Okay, thank you. What happens when an individual makes investments on behalf of their company as they couldn't open an account in the company name?
Well, they'd be doing that in a nominee capacity, really. So it'd have to be reflected in the company's accounts and in the company's corporation tax return.
Okay. How is the £1,000 trading allowance affected by all of this?
Well,
does it apply if there's a trade?
If there is a trade, but as we've said, it's very unlikely that you are going to be trading for income tax purposes.
Yeah, and obviously the background to all this is historically, when people have traded, or let's call it trading, day trading, amateur investors in the stock market generally lose money. And that's why HMRC historically have always been reluctant to accept it as trading, because trade losses can be offset against any other income. So for that reason, they probably also believe that more people have lost money on crypto than have made money. And so we think they'll hold the line on that, because if they cave in on crypto, then they're going to have a problem on their hands for more traditional forms of investment. So it's not likely to appear that often, but there certainly will be individuals who are sufficiently well organised and professionalised who will be regarded as trading. So there's probably a bit of an element of cherry picking here from HMRC that's going to go on, I think.
Okay, yeah.
Okay, thank you. Well, we've still got questions coming in. I'm only going to ask a couple because I appreciate you gentlemen have given your time today. If you're a non-UK DOM resident, but your company is off-site, i.e. Dubai or Gibraltar, etc., what are tax monies brought into the UK subject to?
So we're talking here about an offshore company that's beneficially owned by a UK res non-DOM. That offshore company makes money from the crypto transactions, and the question is, if that money comes to the UK, what's the tax analysis?
Yes, that's right.
Okay. So in these circumstances, we're talking about the definition of a relevant person. So the fact that the UK RND is a shareholder in the offshore company makes the offshore company a relevant person. Now, unless the gains made by the offshore company, unless they're protected by what is called the CGT motive defence, Section 3, which means that the assets that it owns were not acquired, held or disposed of with a UK CGT or corporation tax avoidance purpose, then they get the motive defence and they're not attributed to the shareholder. If they're not attributed to the shareholder, they don't become his gains, and then although it's a relevant person, if the money comes to the UK, it's not a remittance of his gain, so it's not a taxable remittance. But if it doesn't benefit from the motive defence, then there would be a taxable remittance in those circumstances. So the question of whether it's taxable or not will really depend on the history of the company. And I would say broadly, where it's going to come out is that if you've got a UK res non-DOM who's already established an offshore investment company before they come to the UK, and all it's done is churn its existing investments, perhaps it's got into crypto later after he's become UK res, then there's a very good argument that the motive defence should always apply, because he had the structure before he came here, he hasn't put any new money into it, and therefore we should get the motive defence. The gains are not his gains, so in theory the money could be lent to him in the UK without a taxable remittance, but obviously you have to be extremely careful and analyse each case on the facts.
Okay, thank you. And our last question that I'm going to ask today, which we've had from a number of questioners, if an individual has reported his or her mining income as trading income, however, by looking at the scale of the activity and resources committed, this is definitely not a trading activity, can we make an overpayment relief claim for the overpaid NIC for the previous 4 years? Oops, someone's fallen off their chair.
That's such a shocking question. Right, literally fell off his chair there. Lucky that we're not on camera. Yeah, I mean, overpayment relief, I think normally it's reserved for very obvious errors and not a change in view. But I think it would be worth, you know, in view of the unknown quantity that we're looking at here, HMRC's evolving views, I think it's not unreasonable to make an argument. And, you know, the worst that can happen, obviously, is your overpayment relief claim will be turned down. So I think it would be worth a go, actually.
Okay, great. Thank you very much indeed. Well, we'll draw that to a close now, because that's been a really comprehensive webinar today. So thank you very much to Alan and Ryan for your contributions today and for your time. If anybody wants to get in touch with either Alan or Ryan, you've got their contact details there on the slides. We will be sending around a copy of the slides, as I mentioned at the beginning, and potentially a recording as well. So Alan and Ryan, I invite you to say your goodbyes.
Thank you very much. Thanks, everyone.
Thank you, everyone.
This is, of course, one of our usual monthly webinars we produce for our clients and member firms and selected guests. Having said they're monthly, next month we're giving you January off as a sort of sympathy vote. However, we will be back in, I think it's the 8th of February, with an IHT lunchtime webinar. So thank you again for listening. If anybody would like to speak to anybody about anything we've touched on today, please do get in touch. Thank you very much. Have a good day and have a good festive period, and we'll speak to you next year. Bye-bye.